Greetings, everyone. It is Tuesday. And Justin, I said before you came into the room, I let people know that they would be pleasantly surprised because you are our guest today to discuss CoreWeave. Now, Justin, can you really quick introduce who you are and what type of relationship you have with Stock Simplifier, the tool we're going to use today?
Gotcha. Well, my name's Justin Lamb, and I work with the Bryans, and I guess you might say I'm the developer behind Stock Simplifier.
You
Trying
built
to,
it.
yeah,
Built
okay, I built it.
You built it. And so we're gonna use it as we go through today. Now, Justin, the other thing I just wanted to say before we get started today is you joined me like a month and a half ago for a special after Anthropic released a press statement talking about Mythos.
Yes.
And I just wanted you to know that has been the most rewatched of our live Tuesday sessions. So
Really?
you're back by both Feroldi being in Boise, Idaho, and popular demand. You get to choose which
And
one.
as fate would have it, Mythos is supposed to actually come out and get released today.
Oh, really?
Yeah,
Oh,
I was
wow.
just
Okay.
reading about that before we got on. Yeah, everyone's the rumorville is saying that Mythos is coming out today.
Now, does that mean you or I could use it too?
In theory.
Wow. Okay. All right. Well, it's good because today we're going to be talking about a company that I believe that you're pretty familiar with, CoreWeave. Now, two things. One, I was a little bit surprised when I looked at CoreWeave's stock chart. It's actually down about 40% over the past year. It's up since the new year. And when we talk about how hard this is to understand, I think Feroldi and I would probably say it's somewhere like right here. But that's why it's great to have you on board so that you can help us know more about it. Before we get started, we want to ask folks that are watching, do you own the stock? So go ahead and make a comment in the comment section. Let us know if you own the stock. Justin, I'll start out by saying this is not a stock that I personally own. I'm curious, one, if you do, or two, if you've got a history.
I have owned this stock before. So
Okay.
not currently, but I'm very interested in the space. I think that this space has a very rich future.
Okay. I will say that it sounds like you and I are with everybody else here pretty much. I think there was one person, Keith, who said yes. And Keith also shot us a very detailed message that we could go over a little bit later. But it looks like we've got a whole bunch of people that are watching that do not own shares of the stock. It's good to see we're working on YouTube too, because Jimmy says he does own it. But let's go ahead and get started. And as we do go through this, one thing I want to point out is that we will be using Stock Simplifier 2.0. So before we used to do this, and we were using our old spreadsheet and prompts, but now we are in Stock Simplifier, and we will show you how you can get access to this at the end of this. But we're just going to go ahead and start with the ticker symbol CRWV. This is one of the stocks that is covered in this universe, and I believe we've got some updated deep dive on it. Now, this is a $52 billion company. I was a little surprised when I saw that. I don't know if that's something that you're particularly surprised by, Justin. Does that size, surprise you?
I mean, if you look at the CapEx spend in just the Mag 7, it doesn't surprise me, especially given what I will just tee up what you're probably going to be describing what CoreWeave does and who is their biggest supporting partner.
Okay. Before we do that, I just want to point out we've got their mission, because there's going to be people watching this that don't know what CoreWeave is. They probably see the ticker all the time, don't know what it is. To power the creation and delivery of intelligence, the intelligence that drives innovation. Now, it is up 22%, and that is beating the S&P 500 so far this year. But over the past year, it's actually down. It's underperforming by about 60 percentage points. And it hasn't been public all that long. You could say a lot of that underperformance is because of this big boost it got right when it came out of the gates in the middle of last year, because we're about lapping the height of that right now. This was June 18th, June 20th of last year. So let's get into what the company does. And I will zoom in a little bit here too. Is that better, Justin?
Yeah, that's actually way better.
Okay, cool. So they run a cloud built for one job: training and running artificial intelligence. Okay. It rents out big clusters of high-end graphics chips, plus networking, storage, and software that make them useful to AI labs and enterprises. Now let's stop there for one second. When you see high-end graphics chips, you have background here. Does that mean like NVIDIA chips?
Yep.
Okay.
That is their biggest backer.
And when they talk about AI labs, is that Anthropic, Gemini, OpenAI, things like that?
Yeah, they essentially, for all of the LLM frontier models, when they need additional compute power, they head on over to CoreWeave.
Okay. So most of that work is sold on multi-year take-or-pay contracts. So customers pay for a set block of computing power, whether they use it all or not. It's kind of like your health savings account right there. You get to December and you just got to use it all. Except I think it's like a health savings account where you're running to the hospital every day. The company began in 2017 as a crypto mining operation. And then they pointed the same chips at AI when that demand took off. So correct me if I'm wrong, but this is kind of like, sometimes it's better to be lucky than to be skilled. Like the NVIDIA chips were what was needed for the crypto mining, and the fact that they had a whole bunch of them, and I believe they have a relationship with NVIDIA too, that put them in the right place at the right time.
Yeah, GPUs were great for mining cryptocurrency, and turns out they're really good for training AI. So NVIDIA finds a windfall, so does CoreWeave.
Let's talk about this right here. What sets the model apart is how it's paid for. Rather than general purpose cloud, it's built for AI from the silicon up and tends to bring each new NVIDIA chip generation to market before rivals. How does it do that?
You gotta love a good relationship and Jensen backing.
Okay.
It's
All right.
that's in the contracts.
All
They
right.
get first dibs.
That's pretty good. Now, just out of curiosity, we might see this as we go through Stock Simplifier, but did that exist before the Chat GPT moment? Like, did that relationship exist when it was just crypto, or maybe we're not sure and we might find that out?
I don't believe so, but I don't know. I don't know for sure.
Okay. CoreWeave funds the cost of building data centers largely with debts secured against those signed contracts. So the promises customers make are the same thing that backs the loans to build their capacity. So who do they sell to? We've already talked about this a little bit. Large AI labs like Anthropic buy committed capacity and train and serve their models. They also serve hyperscalers and big tech. So Microsoft and Meta rent capacity to supplement their own infrastructure. The twist is that some of these buyers, Microsoft through Azure, also compete with CoreWeave in the broader cloud market. So is this a little bit like, I remember when Tesla was just getting started in the EV market, not only was it competing against other companies' EVs, but they were supplying the batteries that were going in the cars of those companies. Is that a fair analogy there?
I would think so. I think this just shows how much demand there is and how
Mm-hmm.
much lack of supply there is when it
Mm-hmm.
comes to compute.
And then there is also enterprises that are adopting AI, like trading and quantitative firms such as Jane Street and Hudson River. But if we look at it, we don't have it really broken down by any segments, but this is almost entirely United States revenue. How predictable is it? This says very predictable because of that take or pay backlog. There's a committed contract mix with large term deals making up the majority of the revenue. The risk, however, is concentration. The backlog is real, but much of it sits with just a few large customers. I would guess Anthropic, Meta, and Microsoft would be three of those very big customers. Now, Can it raise its prices? Sometimes. It can charge for scarce differentiated capacity, being the first to new NVIDIA chips and the only top benchmark rated provider. But its biggest customer runs a rival cloud and pushes back on price. So it is differentiated. They do get the NVIDIA chips first, but the fact that they're serving someone who also rents out the same type of capacity, that does put a cap on their prices. Would it be fair to say that right now, it's almost like right now, companies like NVIDIA and CoreWeave and optics companies, they're all like water vendors in the middle of a desert. Like it's almost like they can kind of set their own price. And the question is, once we get closer to an oasis, once we get closer to somewhere where there might be more water or supply and demand kind of even out, the real question is what happens then? I'm just curious, is that fair? And do you have any insights on what happens then?
Yeah, I mean, I think this really gets to the the heart of the paradox you love talking about in Jevons paradox.
Mm-hmm.
It's really, is there a limit to the demand of intelligence? Because
Mm-hmm.
compute essentially is the equivalent of intelligence. The more
Mm-hmm.
compute you have, the more intelligent model you have, the more you're able to deploy that into your business, projects, workforce, whatever. So it gets to the heart of the question, how much demand is there for how long?
Mm-hmm.
And will it plateau?
Mm-hmm.
I
Is it
wish I
recession?
knew.
Yeah. Is it recession proof? Well, they do have a backlog of take or pay. It is mission critical. It's riding this AI wave. Where are we on that S curve? That's the $1 trillion question. Where are we on that S curve? And what's their competitive position? It's a credible specialist leader, the only top benchmark rated AI cloud, and the first to have the new chips, but it does compete with larger hyperscalers. And that's worth knowing. Microsoft drove 2/3 of revenue and runs Azure. 2/3? That's crazy. Microsoft is 2/3 of their revenue. Wow. Does that worry you at all?
Yeah, the concentration is the interesting part.
Mm-hmm.
But as we get into the how the contracts are set up,
Mm-hmm.
it's less worrying, but this
Mm-hmm.
goes to the heart of the demand issue. How
Okay.
long is that demand going to sustain?
Okay. I'm just looking in here. So right here, what to watch. This is in our deeper dive that's in Stock Simplifier. Microsoft alone was 67% of revenue last year. You got to watch whether newer wins like Meta and Anthropic and more labs genuinely spread the base. So, yeah, that's some serious customer concentration. You got to know whether or not their charging power holds as the build out scales. And the other big question is whether AI demand proves durable rather than just a spike. Again, for those unfamiliar with Jevons paradox, the idea here is, you could go back to a time when the first coal-powered industrial plant was formed, and all of a sudden you would have said, great, everybody will be able to use their lights for nighttime and that'll be demand. But Jevons paradox is the cheaper something gets, the more it gets used. There are limits, though. I always say to Justin, if oil all of a sudden went to $10 a barrel, I wouldn't just get in my car and drive around all over the place because that's not how I want to spend my day. But if you can run agents in the background all day long and your competitors are doing that, well, those are different dynamics. What I've been reading a whole bunch about companies that have been pulling back on their token spend because they're burning through them so fast. Does that worry you, whether or not this is durable or just a spike?
Yeah, and this is a question I've been asking myself for a long time, because the biggest difference, I love your oil example. That's a tangible product.
Mhm.
This is an intangible because it's intelligence.
Mm.
And
Okay.
to me, that's the biggest difference, where our intangibles, is this the beginning of infinity,
Mhm.
or is there a limit? And so for myself, I've come to the conclusion there's no limit. I don't see one.
Okay.
But it gets to power, and that's just where I'm at. I don't know if there will be a limit. I'm assuming there will be a limit to the supply.
So by power, you're saying there could be like the power energy, whether it's nuclear, solar, whatever, that's where the bottleneck is.
Yeah, I mean, the biggest bottleneck right now is permittings to build the facilities,
Did you
to
say
create new
permits?
ones. Permits, yeah,
Yeah.
regulations.
No, that makes sense. I've talked many times on these Tuesday sessions. We have one of the biggest data centers, I think, in the world, going in about 20 miles north of here. I'm going to drive past it tomorrow, actually. And it takes me 2 minutes to drive past it going 70 miles an hour. It's huge. All right, so let's let people weigh in here. What is your opinion of CoreWeave's business? Is it a 1, which is a pass, a 2? I'm not sure if I'm interested. 3 is curious. 4 is, hey, I really like it. 5 is, this is the future. I'm excited. I want to learn more. Let us know in the comments section what you think. I know for me, I say for me this is like a 3. And Justin, the only thing that gives me some reticence is that concentration risk.
Yeah, I mean, for me, the industry of these types of companies, I'm a 5.
Okay.
Without a doubt. When it comes to CoreWeave, I'm not really sure, but I kind of look at this step as, am I curious about the business within the industry? And that's what I'm most focused on.
All right, so I'm going to go, it looks like 3 was our most popular answer, or at least our average. So I'm going to go here with the 3. This next one we're going to move through relatively quickly. Now you can see back when it was just focused on cryptocurrencies, it wasn't bringing in all that much compared with where we are today. So it went from $300 million to $2 billion, and then from $2 billion to $5 billion in revenue. Now, obviously, they had a huge jump in their operating profit when all that money came in, but they've been plowing all of that back. So I love this, Justin. This says it was in phase 3 for a long time, and now we're in phase 1. I think it's fair to say the whole reason we're in this phase, and we can actually click on this button right here, and it takes us right to the company's page on fiscal, and we can see right here, well, why did that happen? Oh, well, that happened because they're spending hand over fist. I mean, look at their SG&A spending went from 100 million to 3.7 billion. That's a big increase right there. But I'm going to go with them and just say we're in phase 1. But this next one is the really interesting one. Now we're going to go through the Moat in just a minute and see what people think. The size of the Moat, Mr. Feroldi has convinced me, is one thing. The direction of the Moat is where people make their money. I'm still grappling with this because I think he's right. I think that's where stocks get re-rated, is when their moat is growing. So Stock Simplifier says CoreWeave has no moat yet. It's building a strong contracted lock-in, but it does not earn excess returns a moat exists to protect. Now, of course, we know it doesn't own that because they're building, right? So they have operating losses, big cash burn. Their one strong source are those take-or-pay switching costs. And 2/3 of their sales come from Microsoft, which could move the work to its own cloud. So on the one hand, this looks a little bit troublesome. Do you agree with that?
Yeah, I completely agree, because it's compute. People want to have right now, the contracts are the biggest benefit for them, because those contracts, since it has so much demand, if you don't get that contract in first, then you're winding up, where am I going to get the commute, or where am I the compute power? Yeah.
Okay. All right. On the other hand, it says the moat is widening because contracted bookings and a first to new chips lead are stacking up barriers that could harden once the profits arrive. So bookings are compounding. There's a lead in the chip access, which we've talked about. The NVIDIA ties are becoming deeper. NVIDIA is a supplier, a build partner, and a shareholder, which is tough for rivals to copy. Again, just it's talked about backlog a whole bunch. If we go to Fiscal AI and we go to segments and KPIs, I'm guessing so they've got contracted power capacity and remaining performance obligations. I just want to look at these right here. First, the total number of data centers that they have. Let's pull that up. So that's been growing, and boy, if you look at this, this is actually kind of impressive, Justin. They put 6 data centers online in just 3 months. That's pretty good.
Yeah. And they get access to the newest and best chips, so they can be the most efficient. And building data centers is difficult, so they're leading the charge.
Let me ask you about this. We haven't talked about power capacity at all in anything that we've done yet. Why is this so important, having contracted power capacity?
I look at the chips as almost like a person. They're
Uh-huh.
hungry.
Uh-huh.
And if you can't feed them, if you don't have enough food, which is energy, they
Mhm.
start to starve and they don't do anything. They need power more than anything else.
And so they're signing contracts to guarantee that they get that power. And that is doubling because this is on a quarterly basis. It was at 1.6 gigawatts a year ago, and now we're at 3.5. So that's pretty big. And then this is the big one, which is remaining performance obligations. This is what fiscal has. That's the closest to what the backlog is. So we see that grew by 342% year over year in the previous quarter, and it's growing. What is this one? 572%. So people are signing on, specifically Microsoft. Now, how hard is it to switch? It says leaving is costly. The capacity sells on take or pay terms unless under multi-year deals. The commitments are deepening. It's the friction lives in the contract rather than the deep product integration. So this is all about believing that no one's going to break these contracts. But it
And
does say,
Brian,
yeah, go
while
ahead.
you're there, Jamie has a good question. How a company does not have a moat and it's widening?
Mm-hmm.
Would
Well,
you like to take that one?
I'll tell you my perspective, which is I like what this said, which is you've got to prove you have a moat by earning excess returns. And I will say when you are in a very fast growing up and coming industry, it can be very difficult to know what is a moat and what isn't a moat. However, when you look at data like this, and this is contracted revenue that's going to be recognized in the future, and you see it this quarter basically quadrupling, the next quarter sextupling, I think it's fair to say that whatever form a moat takes, it's probably growing around the company. That's my opinion. What do you say to that?
Well, I'll give you guys the inside baseball on Stock Simplifier.
Mm-hmm.
If the moat is at a 0, it can't get worse.
Huh.
So
Mm-hmm.
it's either stable or it's going to be widening. And that's
Okay.
how we grade it in the background. So because they're making efforts to
Mm-hmm.
increase it,
Mm-hmm.
it's widening.
All right. I will also say that NVIDIA partnership is clearly an intangible moat that they have. Again, it hasn't led to excess returns yet because they just brought 6 ginormous data centers online in the last 3 months. That's really, really expensive. But I think that the combination of that NVIDIA deal and selling water in a desert is why you could say that it's widening. To go down just a little bit right here in our deeper dive, it talks about how that lock-in, it's contractual, the friction is in the contract, but I also like coming down in the what to watch area. So it says, what is the path to operating profit? They need to see that it's able to defend excess returns. The backlog needs to convert to revenue and show that they have renewals. And if rivals like their biggest customer, Microsoft, somehow get the newest and coolest chips, well, then that could erode some of that moat. So that's what to keep an eye on. I'm curious what people think. Let's hear people give their ratings. First, give a rating for the size. 1 is none, all the way to 5 being wide. And then give a second number for the direction, a 1 being narrowing, all the way to a 5 being widening. And Justin, maybe are there some questions we can take while we do that?
Yeah, right now we're pretty good on the questions.
I see a
Jamie was
couple.
the first one.
I see Brandon asking this one. He thinks that there's minimal switching costs. He thinks these are like grocery stores. What do you say to that?
I wouldn't go that minimal
Is he trying to
because you
poke the
still
bear
have to
here?
go in. I think he might be having fun with that, but I don't see them as being consequential. Like, I think a Salesforce has much more switching costs than switching your compute provider.
Okay. All right. So there is something to what he's saying.
Yeah.
Yep. Okay. Let's see. What I've got here is I've got a 1 and a 4, a 2 and a 4, a 2 and a 5. I think it's fair to say most people are saying this is a 1 or a 2, and it's expanding. So I'll go with that. We'll go with a 1 and a 4, and we'll move on to the next one, which is growth analysis. Now this is the whole story, right? Our stock simplifier gives us a 5. They say growth sits far above the bar for a high rating. Revenue compounded at triple digits over 3 years, and it's running over a doubling year over year off of a multi-billion-dollar base. Now, that looks kind of slow, and we're taking our data here from fiscal, but that's because this is just 3 months of growth. If we look at the revenue growth and we look at what's that doing year over year on a quarterly basis, I think what you're going to see is that it's growing very fast. So, Justin, it looks like it's plateauing, and no one loves seeing plateauing, but can you see what it's plateauing at?
Plateauing at triple digits. If that's plateauing, could I plateau more often?
Right. That's not bad. So that's why it earns this 5. In the first quarter, revenue rose 112%. The demand is already booked. The earnings have been getting worse. Does that concern you at all as someone who's owned this company in the past?
It's these are part of the whole circular payment conversation that's going on.
Can you explain that a little bit?
I wish I could explain it.
Well,
to really make it make sense.
What does that mean?
It's essentially NVIDIA will not only sell the chips to a company like CoreWeave, they'll loan them. And then you can just
via share
essentially
ownership.
rent them. Yeah. Where essentially NVIDIA still owns them.
Mhm.
They're renting them. And then if you can't pay them, you just give them compute. So it's this intermingling that for many people, especially finance people, it has a bad smell to it. But you wonder if this is a little different than times of the past because of what's going on. And so far, when you look at the supply demand curve, the demand is exponential to the supply. People can't get enough.
Let's see what Stock Simplifier says. It funded a multi-year build. CoreWeave and NVIDIA are accelerating more than 5 gigawatts of AI capacity by 2030, with a stated goal above 8 gigawatts, a bet that demand keeps absorbing compute. Spend is pouring into AI. There's no doubt about that. Durability is the question. The end market clearly expands today, but management notes that broad AI adoption is uncertain. So growth rests on continued demand, not a settled defensive market. And could CoreWeave have new offerings for growth? And Stock Simplifier says likely. The software layer is in hand. It bought Weights and Biases, an AI developer platform. It's moving up the stack into software that it can sell on top of compute. It is proven as an acquisition engine. It folded OpenPipe, Marimo, Monolith across 2025. A repeated record of buying and absorbing adjacencies that lowers the risk of the next one. In other words, I would say they're kind of becoming more vertically integrated. I wouldn't say they're vertically integrated because they don't make the chips, but they're becoming more vertically integrated. These bets span developer tooling, agent training, industrial simulation off of a big compute base. And we can also just read a little bit more. The backwards history confirms the forward read. Septupling trailing rate against a tiny base could look like an artifact, but it still grew 167% and even 112% in the most recent quarter. So what are the big things to watch? This is what I like going to in the deep dives. Revenue, the 3-year revenue growth rate, the backlog, the mix, 98% is coming from take or pay deals, active power. So they're at 3.5, and Justin, we saw they want to get to 8. And their customer concentration, that's a big one. So we need to watch the backlog, the demand durability, and this software stack and whether or not it could help out. So let's hear what folks have to say on a scale of 1 to 5. What is your opinion in terms of the growth potential for CoreWeave? One note here from Brandon, while people let us know what their ratings are. He says the key is the flow of capital. NVIDIA and AMD get to book crazy revenue by offering equity in exchange for chips. I think he's talking about the circularity of this. Like the more that NVIDIA gives CoreWeave and gets ownership in return, the more it can pump its revenue. That is a problem when times get tough. It's just that it doesn't look like those times are coming anytime soon.
Yeah, if you scroll up, an interesting little factoid that I hope I'm going to say this right. If you scroll up right above the what to watch.
Yes. Okay. Give me 1 second.
Okay, right there. It's kind of fascinating. You're going to go from 3.5 gigawatts, and you said they're going to go head up to about 8. So
that's
they're
what
going to more than double the power. And token efficiency or intelligence per token is the efficiency is increasing or decreasing by like 90%. Tokens are getting like 90% cheaper each year over year. So they plan on doubling the power and they're getting 90% more efficient year over year. How much more intelligence you can provide at that level, to me, it just, the future is going to be wild.
So they might double energy, but compute per unit of energy could 16x.
Yeah.
Okay. What do you have to say about this comment coming from YouTube? All the neoclouds are actually very different. CoreWeave is mainly bare metal, despite their reference to software, which we just talked about. Nebius, it says, is much further along on software, and that's why it gets a premium. Now, we could, we're not going to do it in this hour, but the beautiful thing about Stock Simplifier is as soon as we're done with CoreWeave, you could just go to Nebius and do that and compare your notes. Is Nebius a stock that you own or are familiar with?
Yes, Nebius is a stock. I don't believe I own them today, but I have owned them, and I've owned them this year. Okay. So I've kind of been in and out of them. I know they are a little bit more vertically integrated. I actually didn't know that CoreWeave had the software, so I got to learn something new today.
There we go. There we go. And John is already asking if we can do Nebius next week. Let's see what most people said. It looks like we got a bunch of 4s, a 5. We got some 5s. I'll be a curmudgeon and give them a 4, just based off of trying to be conservative here. Let's talk about management for a second. So management, they gave it a 3 out of 5. It has a founder team with heavy skin in the game. Love that. A clean revenue beat record. Love that. It's offset by operating losses. Doesn't bother me too much because we understand why. Mixed employee reviews, unproven early economics. So all 3 co-founders run the company 8 years on and hold every super voting share, betting their own net worth on the long-term outcome. And you can see co-founder and CEO Michael Intrator owns over 10%, worth about $7 billion. He co-founded it in 2017 and has been the CEO ever since. He came from energy trading, co-founding Hudson Ridge Natural Gas Hedge Fund, and helped pivot a crypto mining operation into an AI cloud. So let's see. Do employees like working there? They get 3.6 out of 5 stars. Generally, they like the CEO, 91% approval. That's pretty good. But only 55% would recommend working there to a friend, roughly a coin flip. So I would say that's middle of the road. Do they beat expectations? Yes, 5 beats in 5 quarters. Their growth is ahead of the bar. Are they shareholder friendly? Well, there's ongoing dilution. The company has raised fresh equity since its IPO, including a large stock sale to NVIDIA. And of course, you can always just head on over here to Fiscal to look at those actual numbers if you want to. All you got to do right here is click on diluted shares outstanding. And yeah, I'd say there was a pretty big equity raise in there. So for me, Justin, I look at that and I'm like, whoo, that's a lot. And at the same time, I'm thinking, yeah, but how are they going to build those data centers if they don't have this? What's your take?
Yeah, it's, this section more than I do. It's data centers aren't cheap.
Yeah.
And they need to build them, and they need to build them right now. Speed is the priority.
Yep. And as Hemgoff says, the markets right now, because this stock, again, down 40% over the past year, are obsessed with punishing CoreWeave for their financing structure. The thing is, okay, so here's the thing. Most people don't understand this. Most people think that issuing shares is cheaper than taking on debt. So that's baldly not true. Okay. Just that I can say that because if a company grows a whole bunch in the future, those original shareholders have given up a lot. But issuing shares is much safer than issuing debt. In fact, it's more expensive because it's safer. You're giving away, in this case, half of their future earnings because it's safer. And so you've got to decide whether or not that's a trade-off that you feel okay with. So yeah, that's how they're choosing to finance themselves. If we just look at how strong are their operating margins, not great. They're running in the red now. They're doing that because here it is. They are building out their data centers, and that's a big deal. It's really expensive. The key question is what will happen over the longer term. So let's skip this one. We'll just give the management team a 3. I really want to get to this execution risks because this is the really, really important one. While we get to that, there's a couple of questions in here. Keith says, how about insider sales and purchases? Nebius has been a buyer, CoreWeave a seller for what it's worth. Does Simplifier factor this into the analysis? I'm curious, Justin, since you're the brains behind this, is that something that gets factored in?
Not yet. That is on the roadmap, and I actually put it in the chat. Is a great idea to introduce it. We do have a feature request section, so if you are a subscriber, please go on and request those features and upvote the other features that you want to see added in first. We're still, this is a new launch. We're still making sure everything's working right, and we want to expand the universe, but that is not the first time I've heard that idea, and it is on the roadmap for sure.
If I click on this, will it ruin my CoreWeave thing, or will another screen?
Let's
I'm be
trying
safe.
To remember. Let's be safe.
All right, let's be safe. Let's be safe. Let's talk about these risks, because these risks are really, really important to understand. First of all, one customer carries it. Microsoft, 2/3 of revenue. That's really important. If Satya all of a sudden wakes up on the wrong side of the bed, I mean, it really depends on how strong those contracts are. Stretched balance sheet. Debt sits near 5 times equity against a thin cash pile. The company burns billions in free cash flow, and operations do not yet cover even the interest bill. Oh yeah, I've got to look at the numbers. I got to look at the numbers if this is the case. I just got to see what the numbers say. So if we go and we look at the balance sheet, so they've got $2.2 billion in cash. It looks like they raised a bunch and then they spent a bunch. How much long-term debt do they have? Let's look at that. Long-term debt. Oh, just $17 billion. And then what's the direction? Where's the flow of money going? If we look at free cash flow, we can look at actually cash from operations, and then we can look at free cash flow because that takes into account capital expenditures. So the good news is that it is generating cash. So they had, and this is, do I still have it on a quarterly basis? I do. Let's put it on an annual basis. The good news is they are generating $6 billion in cash. The problem is that they're spending $16 billion on capital expenditures. That's how that free cash flow is so low. That's also how they were able to open 6 data centers. I hope people understand how big 6 data centers is. That's a huge deal. Yeah, so that checks out. That's a serious risk that's worth noting. Stock Simplifier also says its fate sits outside of its hands. Power, NVIDIA chips, a constant need for fresh capital, that is sometimes beyond management's own control. And any one of them can stall the machine. So revenues are not diversified. Microsoft. Is disruption a threat? Somewhat. Chip generations turn over fast, and the whole thesis rests on AI demand holding. But CoreWeave does have the advantage of sitting at the front of the line because they get NVIDIA's newest chips. How much is outside of their control? A lot. Power. One supplier, NVIDIA. And they need to be able to get capital to keep building and opening up these data centers. And finally, the financials, we just went through it. They're burning $10 billion a year. I'm just curious, when you look at this, Justin, let's just take this out, and they're losing $10 billion a year and they've got $2 billion. Does that, I don't think they're going to run out, but how do you think they are going to manage that?
This is where I should just preface with, and I say it too frequently, I'm a supply and demand guy. I look at it very simply, where if there's more demand than supply, a lot of things just work out.
Sure, because
and that's where I kind of focus. Yeah, it's one of those things where, tell me where you have applied more intelligence to something and everything's gotten worse. And then tell me that you don't want to apply intelligence to any business on the planet. All right, that's kind of where I land. So as long as the demand is there, as long as Jevon Paradox is there, I'm in. For me, on the risk, I really like that it highlighted the dependency on NVIDIA, because let's say something like AMD or a new player dethrones NVIDIA. Unlikely with the current lead, but it happens all the time. We all remember how influential BlackBerry was for those of us that were using them. If something dethrones, that could be a big Achilles heel for CoreWeave.
Okay, that's actually, I appreciate that it called that out too, because it'd be easy right here to just focus on Microsoft, right? But NVIDIA is another concentration risk, a supplier.
Absolutely.
All right, well, let's have folks rate this. A 1 being the risk is very high, a 5 being very low. I think for myself, for the company like this, I would normally give a 1, but I agree with you. When you sell water in the desert, I give you some credit. So I would make it a 2 personally. Where would you land?
I'm annoyingly positive. I'd probably be in the high to moderate because of the single source supplier that automatically drops you. And you have, not only above 10%, a 67% with Microsoft. And right now I haven't been impressed with Microsoft. So those make it, now that I'm talking about it, I landed a 2.
Okay. And that's, I would say we've got a lot of 1s, but we got some 2s, some 1.5s. We'll go with the 2 here. And then finally, valuation. Now, as we said, the valuation here, the stock's performance here is not matching what most of the other players in the AI infrastructure stack have been throwing up. I mean, most of the other players, you look at Micron, you look at AMD, you look at NVIDIA over the multi-year time frame, you look at Bloom Energy. I mean, they're Xing every month, it feels like. Not CoreWeave. We don't have a lot to look at, but we can look at a price to sales of 8.4. That's below its median, but that's still not cheap. Let's see. And what else can we look at? We can look at price to gross profit. I actually think that's a pretty good one, trading at 12 times gross profit. We could look at price to operating cash flow, because as we saw, this company is doing pretty good with operating cash flow. Right now, it's only trading at 8 times operating cash flow. Now, all of that operating cash flow and then some is being used for data center build out. So if that demand disappears and they're left with these big empty buildings, well, then it doesn't matter that it's trading 8 times operating cash flow. But that's not bad. And Justin, this is my favorite deep analysis out of all the tabs we have, because this really breaks it down. Sales, not earnings, is what you should pay attention to. The company's own history is too young to anchor to anything in particular, and the backlog is the real context. I love that, and I agree with that 100%. Just anything else that comes in here. What is the market pricing in at this price? Well, they're pricing in that the backlog becomes actual revenue. I think that's fair. They're pricing in margins that have not yet arrived. That's fair. And they're pricing in concentration and capital holding up. Now, our stock simplifier thinks that this is fair value. What do you think?
Oh, I rely on what my agents tell me in Stock Simplifier because I am not the valuation guy.
Okay. Well, let's
I will agree with that.
Let's ask everybody else. What do you say about this company's valuation? This is a very hard company to value because we don't have much history. But what we do have, I mean, 9 times operating cash flow for a company that's growing 2x every quarter, it's showing 2x. That sounds pretty good. At the same time, they're burning through cash like crazy. So,
well, while people bring it in, I want to ask you a question.
Please.
And to me, I find this is really interesting. We've seen across, I mean, if Jensen names a company, it goes up 30% the next morning in after hours. All of these AI stocks have been screaming. I've seen countless stocks year to date above 100%, 200, 300, 400, even 1,000%. Out of all of those, now reading what you've read about CoreWeave, why is it down 40%? Why is it not partaking? To me, that's the interesting delta in the story, because I hear a lot of positives, but the price is not reflecting those positives. So what do you think? Why is the market not rewarding CoreWeave?
I think the big thing for me is how much of it is outside of their control. And I'm not actually talking about demand, because demand I think demand is outside of almost every company's control. Like, you have to show people that you've got something that they want. I think it has to do with your biggest customer being potentially your biggest enemy, your single provider of differentiation being NVIDIA. So you have to count on NVIDIA not only continuing to re-up, because remember, I don't know how long the contract is with NVIDIA to do this, and they obviously have a vested interest. However, their investment in CoreWeave is really important to CoreWeave. I don't know how important that is to NVIDIA. Like, NVIDIA is like a $5 trillion company. Their investment might be worth $5 billion. That's nothing. That's like going to your coin jar for them. So the NVIDIA part and the Microsoft part, to me, when you combine those with burning through money, That's why. Micron. So Micron blows my mind. The fact that Micron is worth $1 trillion, it
Yeah.
and Micron is expected over the next year to generate $100 billion in profits. That's the difference. You've got Micron making $100 billion here, and you've got CoreWeave burning $10 billion over here. So that's why I think they are not catching a bid.
That makes a lot of sense. Yeah, Micron is one of those unique ones. It's yeah, I'm happy I own that one.
So the average score was a 3. So our composite score here for CoreWeave is a 2.8. I put this on my watch. Actually, I probably put this on my pass just because there's too much for me to need to keep track of to know what to do with this. I want to get to one last question before we let folks know how they can use this tool itself. Ralph says, isn't depreciation of the GPUs a big problem? Replacing all the NVIDIA chips every 5 years. I have learned a little bit about this. I have a feeling that you might know more. So I'm just curious to your thoughts on that.
Yeah, it's been a surprising situation, and I think they're going to have to readjust their depreciation on those.
Mm-hmm.
Because if you're looking back at H100s, the cost to rent them has actually gone up over the years.
Mm-hmm.
So when you're looking at the actual cost of compute, it's not aligning with the depreciation schedule, where
Mm-hmm.
I've heard a lot of other people say that you might want to start depreciating these things at 7 or 8 or even more years,
Mm-hmm.
because everyone thought, oh, the new chip is just going to wipe out the old chip. Not so. And I'm a repeating record, but the demand is just so high, people can't get enough. When the cost of the multiple years ago chip goes up in value, it's a rarity. I don't really know how to do that, and I don't know how long that's going to sustain.
The other thing that I've heard is just that this isn't a situation where you have to replace all the chips. This is a situation where you spread out the capacity across your data centers, and those H100s will work in tandem with whatever the newest version is at that point in time. So you're not taking the H100s out back and just getting rid of them. They're actually part of the machine that would still drive this forward 2 or 3 years from now. Is that fair?
Sorry, are you hearing me okay, Brian?
Yeah. Yep.
Okay. William was saying that you couldn't hear me, so
Oh, no, I can hear you.
I got sidetracked. Do you want to repeat that question?
Yeah, well, just what I've heard is this idea that all the NVIDIA chips need to be replaced every 5 years. It makes sense and it's prudent to assume, but in practice, they're not replacing them. They're just working in tandem with whichever the newest version of the chips is.
Yeah, and this goes to the point of inference. You can use the older models on inference, and inference is the far longer tail. Not everybody's training. People are just needing the compute for inference, and we haven't even entered in the stage of robotics. We're still in text generation. We're barely in video generation.
Got it. So there might come a day where the depreciation on those becomes a factor, but the bottom line is those H100s are far more valuable over a longer time than they were expected to be when they were first put in.
Absolutely.
All right. Well, let's talk a little bit about folks that might want to, as soon as we're done with this, go on and run this very same thing on Nebius, because we had a whole bunch of people saying, well, Nebius does this and CoreWeave does that. The beautiful thing about this is that Stock Simplifier, you can run a lot of companies through this. Now, we've got 2 different plans if you want to use this. The first is the standard plan. It's $16.60 a month. You get billed $199 annually. You can do 20 analyses per month, US covered stocks, and you get all the different things that we just saw. But if you get the pro plan at $33.25 a month, billed at $399, you get the fundamental and the deep analysis, the multiples and the reverse DCF. the standard and the custom watch list. You can export it. And I didn't even show how you can take notes and keep track of things while you're doing this. However, for everyone that joined us today, they just spent the last 55 minutes with us. We're giving you a deal where it's $24.92 per month, billed at $299 annually. And it's also important to point out that if you would like this deal, we have a free money back guarantee. If you're not happy with Stock Simplifier in the first 30 days, you just let us know and we'll issue you a full refund. So if you could put that in the chat, Justin, so everyone can see that, and I will make sure that the same gets through to folks, because I'm realizing now that anybody who is watching on our on my YouTube feed, you can't post on my YouTube feed. I need to post. So I will put that in and make sure that folks get to see that. And the link should be in right now. All right, there we go. A couple quick questions. Someone was asking, do you need access to the paid version of Fiscal AI as well? Justin?
I would say no, because I don't have a paid version of Fiscal. So I just click on that Fiscal link on the top right-hand corner, and then I can see whatever it is I need to see if it's not in Stock Simplifier.
All right, awesome. And we pay Fiscal for the API to be able to pull this. Yeah,
and they've been great partners. I will say I've learned a lot about Fiscal's data, and we've been doing a lot of double checking. And I think this partnership that we have with them, it's actually making all of the data more valuable over time.
Got a couple of votes here. One saying that they would like, is that ConAgra? I'm not sure what CAG is.
I'm not sure what CAG is. That's a new one for me.
I'm guessing curious, it's not, because it's very different than the stocks that we normally talk about here. There's
ConAgra.
Oh, it is. Oh, there you go. I could actually understand that, because, oh, there you go. Because commodities could be under a lot of pressure for a whole lot of reasons. Lars is suggesting Wix. Keep your eye open. I do think, Justin, that if we can, and actually, let me ask you this. Do you think it will be possible in the next week or two for us to do SpaceX in here?
Yes, I am actually in process today of trying to add it in there using their S1.
Amazing. So, and I think they go public on Friday?
Yes. They, yeah, the 11th is for the pre-IPO shares to the retail. And then I believe on the 12th, they go public for everybody.
Awesome. Well, if you want $100 off Stock Simplifier, we've got the code in there. Thank you so much, everyone, for watching. This was really interesting to dive into CoreWeave. I had no idea that they were so reliant on Microsoft and NVIDIA for what they're doing. And now I'm curious about how Nebius might be different. For those that might not know too, I was once a shareholder of Yandex, which was the Google of Russia. And I don't know if you know this, Justin, but the founders moved all of Yandex out of Russia when the war started, and that entity became what is now Nebius.
Yeah, and how much of the founder's wealth is tied into Nebius?
Mm-hmm.
Are you familiar with that?
No, I'm not. How much?
About 90%. So I know you love conviction, and where you put everything on the line. I hope I'm right in saying that, but last I remember hearing, it was like 90% of everything was in the company. This is a no parachute.
That's a no parachute. That's a burn the bridge. You got to make it.
Mm-hmm.
Very interesting. Well, Justin, thank you so much for joining. Mr. Feroli will be back again next week, but I have a feeling that due to popular demand, this is not the last time we will see you here on Tuesday. Again, don't forget Stock Simplifier. The link is in the chat if you want to sign up and get $100 off on that. Thank you, everyone, so much for joining, and we will see you next week. Bye, everyone.